morning goes on, it's Monday. So I wanted to talk. I hope everybody had a good weekend and back in the saddle today. I wanted to talk a little bit about your trading process. A lot of people that I know / talk to, and I'm not talking about a trading system necessarily. I know that, hi Kathy, I know that there's I'll tell you a little bit about my journey. It kind of makes the transition into all of it easier. And if you have questions, pop them in the chat and I'll certainly get to them because it helps me understand what you understand as we go along and we can learn together. I don't pretend to know everything, but we'll figure it out as we go along. All right. So when I picked up trading, I don't know, 15, 16 years ago now, I cannot believe it's been that long. I was always looking for the easiest technical route. And I think that maybe this is the traditional journey. And there was this TikTok video, I don't know, that went viral about a month ago about this individual and his girlfriend. And they said, well, I have a Robinhood account and I just buy stocks when they're low and then I sell them when they're high and I'm now rich. And you and I all know that that is just patently untrue, that that's the way it works. But it's also very easy to get discombobulated in trading. And when I started, the inclination was to look for a bunch of chart patterns and things. When this crosses that and this crosses this, then I should do this. And when this crosses that and, I go upside down and inside out, then I should do this. And before I knew it, I had the fractal soup mixed up. I had multiple time frames mixed up. I had, because you can get a bearish signal on this time frame and a bullish signal on that time frame. And before I knew it, I had no real idea of what was low and what was high in the market. And that's ultimately what we're trying to do. So I'm going to, try and reinforce to you in the least boring way possible about the importance of having a process to your trading, and then to tell you about my process and maybe that helps you with yours. Okay, now the nice thing about having a structured process to your trading is that it'll dictate your psychology. All right, this is always one of the biggest things that one struggles to come to grips with in my mind, is just wrapping your head around what to do when, because ultimately you want to be buying when things are down and you want to be selling when things are up. And that's actually easier said than done, isn't it? Like, for example, if you're looking at Bitcoin today and it's moving up because Elon tweeted some things, that's bearish trend, guys. That is that was dropping on accelerating volume last week. That is probably going down much further. And if we could short it, today would be a short on Bitcoin. But one looks at that up and you're like, oh my goodness, we're going back to 60,000. No, we're not. No, we're not. And it's good to have an idea of your process, because then it'll just dictate your psychology. It stands to reason. But hey, Robert, it stands to reason, but it bears worth saying again. Right now, I like to break it down, all markets. Remember, all markets interplay with each other, okay? And if we have, and now I'm going to just tell you about my general process, and then we'll kind of look at a few examples of stuff to try and solidify what that is. All right, and like I said, everybody, throw your questions in the chat. I'll keep an eye on it, and we can talk about anything today. I'm happy to answer it. I'm going to get through what I had in mind, and then we can talk about anything. All right, so for me, I like to have a macro framework. Oof, that is rough writing there with the rodent, isn't it? I like to have a macro framework as the kingpin to everything I do. All right, and principally, I break up this macro framework, and all of it's based on a rate of change relative to what we got. Now, rate of change, another word for that is calculus. We're not going to get into the math, but it doesn't, the thing about rate of change analysis is it doesn't matter if the S&P is at 5,000 or 500. Okay, it doesn't matter if the pound dollar is at 150 or 120. If it's at 150 and we are going to see an increased on a rate of change basis and an improvement in the British economy and a deterioration in the dollar, then it doesn't matter if we're at 150, we're going to 180, for instance, or said differently, the reciprocal of that. So the nice thing about watching your macro on a rate of change basis is that the price of the underlying assets that are affected is irrelevant. A classic example of that is the DAX, the the Polish, the Swiss, the CAC, the French. It doesn't, those economies in my mind are going to experience a huge boom on a rate of change basis. I'm extremely bullish on Europe for the next couple of months. And why? They had a longer lockdown. They're now coming out of it. Manufacturing numbers a bit. Are they as good as they were pre-COVID? No. But on a rate of change basis relative to what they were, they're only going to speed up. Okay, so it's, and we can spend 5 hours on looking at how we structure this macro framework. But for the benefit of this, hey, Ahmed, nice to see you. And so on a rate of change basis, this is very important. So I like to map the economy into 4 sections, okay? Because I know in certain sections, quote unquote, of the economy, all right, different asset classes do different things. Okay, so number 1 is, we'll call it the Goldilocks sort of period. This is when things are growing, inflation is low. Sorry, the writing there is horrendous, but I'll talk over and you can kind of get it. So, this is when inflation is low, but growth is high. Okay, and this is your little Goldilocks period. So the best asset classes here we know are equities, credit, commodities, and FX being dollar weakness. And generally emerging markets do exceptionally well here. And the worst asset classes here we see are fixed income and the dollar, okay? The best tech, discretionaries, materials, etc. And I can go through all of these, the worst REITs, utilities. All right, the next period is reflation. All right, now, this is what we're in at the moment. Reflation, sorry about that, guys. That writing is Jeffrey Dahmer stuff. Okay, and in reflation, what are we doing here? This is growth accelerating and inflation accelerating. And I got news for the Fed. Inflation is trending, not transitory. Just BTW, which is bad news for them and the consumer, but good for you and I. All right. And what does well here? Commodities, equities, credit, FX, worst asset allocations here, the dollar, fixed income, things that do very well, tech, consumer discretionary, industrials, energy, and financials. Industrials, energy, and financials. These are your core positions. XLF, XLE. Okay. Now there's a common denominator to all of these, which is going to apply to you directly for your FX. XLE, XLI. All right. These are all things that do very well in reflation. The electrification of the entire car industry is all there in materials and industrials. Anyway, we'll get to that. Okay. And, things that do poorly, telecom, utilities, REITs, consumer staples, etc. All right. Now, this is what we're in right now. Okay, increasing growth and increasing inflation, screaming inflation. All right, now, what is the next phase? Stagflation. Okay, this is when you have growth slowing, but you have inflation rising. Okay, what does well here? Gold. I've got some bad news, guys. Gold does bad here. In reflation, gold be bad. One of the best trades we put on since November is gold short relative to copper longs, commodity longs. On an absolute and relative basis, that's been a ripper. All right, gold, bad in reflation because rates are rising, this back tests. But however, in stagflation, gold becomes king. And I'm actually feeling like we're going to probably transition to stagflation, then deflation going into, next couple of months. We'll get to that. All right. And then the fourth period here is deflation. Okay. What other than gold does well in stagflation? Utilities, tech, energy, industrials, right? So utilities did poorly in reflation, what we're in now, but great in stagflation. All right. And things that do very poorly, small caps, all right, value, defensive stock, all do very poorly in stagflation, but do great in reflation. This is why the macro framework is critical, because then your asset allocations relative to that macro framework are what are your core positions. Okay, and then obviously deflation, this is what we saw in the COVID. This is your classic crash time stuff. So what does well here? Fixed income, gold, all right, consumer staples, utilities, REITs, all the defensive things. And then the stuff that does poorly that gets tossed out is energy, tech, industrials, etc. All right, now the one common denominator to all of this, and here comes sort of our framework stuff, is, let me undo that, is that in these three zones, all right, the Goldilocks period, reflation, and stagflation, the US dollar goes down. Right? As a bias, fundamentally, the US dollar does poorly in these three periods of the economy. The only time the dollar does well on a back-tested basis is during deflation. So if you get the dollar right, so dollar up here, so if you get the dollar right, guess what? You're going to get most of this right. Okay? So a lot of times, the US dollar will be your trade signal, and then the applicable the applicable regime of the economy will follow. All right, so getting the dollar right will lead these other things, which comes to another point. All right, so I like to let the dollar often then lead the data. Okay, and then you have subsidiary things like gold and obviously rates, which will lead the various aspects of the economy. So your asset allocations will be dependent on what sector is the wrong word, what phase of the economy is in. All right, and that's calculated on rate of change basis of the data. It's not easy. Right now, so that's number one. Number two is, what is the signal? Okay, and what is the trend? Okay, and then obviously you have tail, but we're not going to get into that. Tail is basically the very long-term stuff. What's happening, 1 to 2 years, 3 years. Okay, trend is 30 to 90 days. And then the signal is 1 to 30 days. Okay, days. Right. So this is super duper important. So at the moment, people are jumping up and down because lumber is down 17% in a week. All right. So the signal on lumber is minus 17% for the week. However, on a trending basis over the last 90 days, it's up 34%, even after the 17% pullback. Okay, so on a fractal basis, right, on a longer term time frame basis, I like to identify the trend of an asset class. So if we're looking at the dollar, bearish trend, if we're looking at XLF, XLR, XLE, XLB energy, these things are all bullish trend, even though XLF might be on a trade signal basis, bearish trend, they are, or rather the trade signal is bearish, the trend is definitely still bullish, okay? And this is what gives us the conviction to trade within the context of the trend. So you might get a trade signal that's bearish, but within the context of a bullish trend. So the number one umbrella is what is the trend? Okay. And then a lot of times the trade signal can lead the trend. And often what happens for myself is I will put on an asset allocation at late cycle that then goes against me that I have to reverse to be in the right direction. And I know that that is the trade signal reversing the trend. Does that make sense? So in other words, a lot of times when the cycle is over, I put on a bunch of wrong trades that tell me, because I've then followed the trend and the trade signal has signaled something else, but because it's been oversold, I bought in the context of the trend, but then I have to reverse that asset allocation. I hope that kind of makes sense, all right? And that often is the signal that things are changing, all right? Now, what do I look for on just a more granular basis for a trade signal? All right, now, if we in reflation, which we are now, okay, and remember our basic core asset allocations are energy. This applies to all stocks, etc., XLF, XLR. This is why I'm looking at Bitcoin, and while I own Bitcoin, I'm certainly not a buyer here. I need the volatility signal to calm down. All right, so, and then the stuff that does poorly, so these are buys, long, buy, buy. Okay, and our shorts, utilities. Our shorts are utilities and consumer staples, etc. Right? But I'm going to illustrate a point. Now, if you're in a situation where you might have, let's say XLF, let's use financials for instance, because I got long XLF last week, huge. All right. One, I have the reflation phase of the economy going up, or this is my framework. Okay. So this means rates are going up, real rates. This means that financials do well. Okay, this is back tested. Now, if I say XLF is the price is coming down, okay, on volatility of it's going to be increasing because it's dropping, but volume is dropping. So in other words, I want to see decreasing volume. All right, I want to see decreasing volume as prices dropping. I don't mind a little bit of volatility, but I don't want to see out of control volatility on the drop. So I want to see decreasing price volume. I want to see stable volatility and obviously a price drop within the context of the reflationary cycle. All right. And to me, this is my buy signal. And I can use things like technicals on the charts, etc., to help me narrow down where the buy support is. But it's that overall trend is up, trade signal might be down, but it's happening on low volume, stable volatility while we're getting a price drop. That to me is my buy signal. Okay, said differently, utilities in Reflation. This is one of my shorts. Okay, so price here can be, so price can be rising. Okay, volatility ideally rising, but potentially sideways or dropping. Okay, but more importantly here, I want to see volume dropping as price is rising. Okay, this tells me that there's less people buying into the rise within the context of my trade signal short. Very important. Okay, then I can look at things like implied volatility discounts to short, implied volatility premiums to buy. Okay, and then we've actually been developing this little tool. I'll post the link in the chat, but it's quite a cool little thing. All right, and we're calling it Embed, which just sounds cool. Oopsie, messed up something here. Hold on one sec, guys. Got a million windows open. I apologize. Okay, and this shows me, it's called Embed, market breadth advanced decline. So I want to see, at the moment I see utilities in the red. If utilities were over here, all right, and what's happening on, dropping volume. Okay, and I notice that they're towards the top end of the range. This would be something I would buy puts on. And if I saw, we had the financials over here like we had last week, and say energy over here, I would see if those are dropping on lower volume and stable volatility, those would be buys. I'd expect them to go over here. All right, so this is a nice little tool that you can see instantaneously if something is being sold or bought, and then you can go and look as to what your factor exposure is related to where you are. All right, but I hope I'll post this little link in the chat. You can play this website. It's quite cool. It's this little app we've been developing. It's totally free. And you can add your own little custom stocks to it and see where those are relative to the market too. So you can see in a moment, and it helps you kind of rotate through stuff, because a lot of times you'll see, XLE might be very overbought, but XLF might be oversold. And then you can go and rotate out of XLE into XLF and switch the money around. Okay, which is pretty cool little tool there. Okay, so for me, price, volume, volatility, big time important to the process. So number one in the process is my economic macro framework. Number two, what is the trend signal? What is the 30 to 90 day trend? Okay, what is my factor exposure within the context of that? What is my factor exposure within the context of that economic framework? All right, then, oopsie, I've lost some chat screens. Anyway, that's all right. And then I can operate from there. Okay, now, another cool way to play this sort of thing is the following. All right, if we look at something like this. Okay, by the way, I have gone huge in this at the moment. I think this is a stealth signal here on gold. Let me show you. Jumping around a little bit, but my brain's busy with this. Expand. Yeah, I invite you to play with that website. Like I said, it's brand new. It might be a little glitchy, but we're figuring out some stuff. Okay, I wanted to show you guys this. I thought this was interesting. The two single biggest factors that determine rates are generally energy and the labor market. All right, 21 states as of next week will be ending the COVID unemployment benefits. It's going to force millions of people back to work. And not a moment too soon. All right. Now, I thought that we would be moving into a little bit of a deflation period, but because we've got this sort of tail push from the labor market, and obviously we have oil breaking new highs, I think that we're going to see more inflation. Now, what made the GameStop thing such a fiasco? All right, it was commercial, it was institutional investors being short. All right, now let me show you this. I'm not always a contrarian, but when I see stuff like this, it really gets alarming. So this is the CFTC non-commercial positioning. All right, this 10-year, look at this, 238,000 contracts on the long side. In other words, these are people betting on deflation. All right, so this is something I watch on a daily basis as to how people are positioning. And I'm not always going to take the opposite side, but when I see massive discrepancies in what I think is right, that's often a trading opportunity, right? And it goes back to why I'm saying, hey, we can be massively oversold on the trend on a trade signal basis, but still in the context of the bullish trend that makes you want to buy. Anyway, so this is 2.5 times the standard deviations from the normal 1-year positioning of bond market contracts. In other words, people are all in head, feet, toes, etc. on the 10-year dropping. Okay? And that positioning has happened here on the 10-year. Let me zoom out here a little bit. Notice the see. Notice the compression of the range here. So this, what is our trending? What is our 90-day trending on rates? 30 to 90 days. So we've got trend up, trade signal down, but notice the compression of the range on rates. And another little stealth signal. What else is rates dependent? Big time rate sensitivity, gold. All right. And yeah, gold's at a big bounce off that mega trend line, whatever. Okay. And we will be long gold in deflation, but at the moment we're in a reflation. Yeah, we had a big bounce there. That's fine. But notice this mega drop here on gold. While we sort of had the touch of the bottom of the range on rates, and we know on a fundamental basis is a tailwind, and we've seen that there's huge unbalanced longs of people being long bonds, which means that they're expecting rates to drop. Remember that bonds is disproportional, or not just, it is inverse relationship to price. So if rates are going up, bond prices drop. Okay, so for me, reflation says rates are rising. Right, remember, this is our frame, going back to our framework. Reflation says rates go up. Gold is a short. XLF, financials are long, energies are long, but we can't touch that. That's off the moon. All right, industrials are down. We can look at that. But more importantly, we are at the bottom of the range in terms of rates. So how do we play that? Short TLT. You can do that with puts. You can be on the long side of TBT. Okay. There's other little ETFs that you can mess with, like TBF on the buy side. This is an inverse to rates. So these, remember, these are inverse ETFs. Don't get these confused now. All right. You know, this is a short where these two are longs, but they're the same trade. Does that make sense? In other words, these are saying that rates are going higher, but they're the inverse. So these are going to go up in price and you want TLT to drop. So you want to buy calls here. I want to be very clear. I know it's a silly thing, but I want to be very clear here. You know, these are calls and this is a put. You want TLT down, put. You want TLT down, but, you know, TBT up. Okay, it's the inverse of the 20-year treasury. And so I'm expecting rates here to go to 1.7 on the short term and maybe as high as 1.95 over the next couple of months. This could be a very important asset allocation that I think you can go big. All right. Now, kind of lost my train of thought there for a minute. Okay, now the other thing to look at in this, and I hope I haven't lost you and got you a little discombobulated on because we talk about process, and I keep coming back to, you know, the three main things. What is the cycle in the economy? What is the what is the trade signal, and what is the trend signal? Those three things. All right, then the trade signal is a price volume volatility orientated thing. The trade signal, or rather the trend signal, is what is its 30 to 90-day relative performance. And you know, we can see XLE is up the world. You know, hard beta is up the moon. Yeah, year to date, XLE 33% plus. Financials 14% plus year to date. All right. What is done poorly in Reflation? Utilities down 8% year over year. So you can see that this stuff backtests relative to that reflationary model we have. Okay, so now let's talk VIX. Okay. What if we had a situation? Notice how we have downward trending volatility. The vol of vol is dropping. All right, on a trending basis. And we have this sort of narrowing and compression of the range. And what does that do? Give us higher lows and higher lows and higher lows and higher lows in the S&Ps. All right, so on a trending basis, volatility is dropping. All right, now what would happen if we went, you know, what is our range? So the 18.5 to 14, we're in the middle. What would happen if we went to 1850 today? All right, this is likely going to take us somewhere in the vicinity of 4190 on the S&Ps. Okay, which also so happens to be our weekly S2. All right, this is daily pivots. Don't pay too much attention to that. This is how I like to use pivots for my ranges on the major assets and then tie them into what the range on the VIX is doing. So this is a multi sort of layered approach to find the singularity of the signal. But let's go over a hypothetical. What happens if we go to 19 or 18, 19 on the VIX, and the S&P is dropping on decreased volume? So volume dropping on the S&P as we sort of rising in volatility. Okay, we get to the top of the range, you know, 18 to 19, and we sit there. End of day, we're at 4190 daily S2 on the, yeah. to me, that's a buy. Okay. But what happens if we get there and volume is just ripping to the upside? In other words, it's up 20% on a 15 or a 30-day basis. Volume is up the world. What is that telling us? It's telling us to wait. It's not telling us necessarily short, but it's telling us to wait. Okay, and what we've actually seen is that volume has been rising, and on a 130-day basis, actually down 26%, which means we're due for a bit of a correction this morning. All right, we're also, right around 15 on the VIX, so we've risen a little bit. All right, now what happens on a hypothetical basis if this VIX pops above, say, 1920, and then sits there for 3 or 4 days, and the S&P sort of trickles down? All right, if we saw this happen on a high volume basis, it tells me that we might be, the trade signal is telling us that, hey, this could go higher, in which case equities are dropping further. But if it's happening on low volume and our trend is down, then that's giving us conviction that we're dropping further. And if we get to 4190 or 4180, and we're going from 18, 19 down to maybe as low as 12 on the VIX, think about what your portfolio looks like then. Then you're talking S&P into the mid fours, like 4,400, 4,500, easy. All right, now, what happens on another, so a nice way to play this too, by the way, and it's, if you're not interested in messing with the index, is you trade something like the VXX with options. And I mean, strictly do it with options because you can get your bell rung. And I don't want you, these are pretty complex synthetics, and there's a price erosion just based on rollover and different things. But, if we get to, mid 18s, 19s on low volume, and we sort of sit there and it's the end of day, and VXX is up around 37, 38, you can buy puts here for a month, and this could drop 50% and your puts are shining. All right, so a nice way to play, to trade volatility is through these other instruments. I wanted to come back very quickly, if you don't mind, and I'm sorry I am jumping around. I really do apologize. It's not what I had in mind. But I wanted to go back to the CFTC positioning again, just for the bond market. Do you guys remember the GameStop situation? Was everybody was short and they got squeezed? This is the bond market equivalent. I bought GameStop at like 20 odd because of this exact setup. It was a high beta, high short interest, people shorted on low volume. It gave me the buy trade signal before any of that stuff kicked in with Reddit or any of that garbage. Okay. And I wanted to point this out because this is telling you that that's a crowded short, and that squeeze could happen just the same. Right? It's the bond market, and it's not going to get the press because it's boring. It's not, the Reddit crowd can't move that market. So keep that in mind. And I'm not always saying be a contrarian, but the signal, this gold is giving us a stealth signal that rates are going up. Okay. Right now, let's talk about a change that we can expect to see in our framework, trade signal, trend signal. All right. Now, I think that because this, and I hope this hasn't been massively boring. I know it's kind of, there's a lot of process related information here. All right. Now, we're in reflation, which means our VIX should drop, continue to trend down. Maybe more importantly, the dollar starts to trend up. Oh, let's check that. The dollar continues down. Okay, now, what happens if we get this boost in employment rates go to 1.85, 1.9. Gold sinks down towards 1750. Okay, and we're sitting in June, July, middle of August. All right, and all of a sudden, we have VIX at 12.5. Okay, and we start to see the VIX push up to, I don't know, 19. And the S&P dumps on huge volume, massive, epic volume. So huge volume up drop. It doesn't even need to be a particularly big move down in the S&P, but a huge drop down. And then the VIX sits above here. Sits above there. And the euro goes from, euro USD goes from 126 to, say, 119. All right, bounces and then starts to show a lower high at 122.50. All right, in other words, we're getting sort of the euro chart looks like this on a daily. It's big cup and handle right now. This is actually a good long here at 120.50, by the way. And we go towards 125. And why do I think that this happens? Well, because my framework says dollar does terrible in reflation. Pounds excellent, Swiss franc excellent, whatever you want, just short the dollar. All right. But now all of a sudden we see something like this happen in the euro, and it's showing a lower high at 122.50. I'm talking about, this is like August, September time frame. And our VIX trade signal saying up. And now our dollar is saying, hold on. Our dollar signal, so let me change to a different color. So the VIX signal is the trade signal saying VIX up, dollar up. And now we have, on a trending basis, we've sort of broken trend resistance on the VIX, and we've exploded on big volume down on the S&Ps. And all of a sudden we start to see China getting real soft. Like they go from stagflation, which is what they're in, to they start to show deflation. Why am I mentioning China? Well, because our macro framework, we look at all of it. On a rate of change basis, that's why I'm bullish Europe, not because I think the economies are great, but on a rate of change basis, they're crushing it. And I don't care where price is, it just tells me that that's where we're changing to, and I know I'm running out of time. China goes into full deflation. The US goes into what we start to see as stagflation. Obviously, what does that look like? Less growth. We're not seeing these ridiculous PCE numbers, etc. So on a rate of change basis, US goes into stagflation. It's very possible then with these different trade signals led by the dollar, led by volatility, that our reflation framework becomes deflation. And I'm not talking about a deep deflationary cycle. It might only last 3 or 4 months. But our asset allocations then change. We get long dollars, we get long gold. All right, we start to see VIX pop up and go from 19 to sort of 28. And now we start getting into the chop bucket of volatility, which is actually a beautiful place to trade. And the things that were longs, energy becomes shorts, XLF becomes a short, utility becomes a long. And it's all because of this collective trade signal that then starts to lead a trend signal. And now you have yourself a process put together. And you can start doing asset allocations relative to that. All right, so it's the everything picture that becomes a singularity. All right. And I probably confused most of you with that information, but I hope you at least absorbed some of it. And I can be reached at Forex David, Forex David on the twit, or C5 David Pegler at Yahoo on the email. And I would invite you to go to that Folio Quest website. It's our little website we put together, and it's all it is a little market breadth indicator. We just sort of beta testing right now. If you have any feedback, let me know. It's a lovely thing to be able to see what's down and what's up. And if you have those asset allocations right, it's a nice little trading tool. Okay. Thanks for joining me. Thank you, FX Street. And I hope everybody has a wonderful rest of June, and we'll see you next month.